Today, I've put together a quick guide for stock selection. There will always be a margin of error in your calculations. Future events and other unknown information cannot be wholly accounted for, and corporate financial data can be manipulated. It is important, therefore, to take a long-term view alongside your valuation and to diversify. There are many human biases which impact our decision-making capabilities. The most common example is how past performance affects our perception of an asset. But of course, expensive assets have typically exhibited strong price performance. Exhibiting strong biases may result in a style or factor preference and lead to a concentration of risk. Companies may have a straightforward focus or be large global conglomerates. It may be impossible to dissect the granular detail, but it is important that a company makes sense and fits into the modern world. The company's development strategy should be clear and focused, and the business should be making sound investment decisions. This is an area where depth of knowledge can add a lot of value. While a company is exposed to the economic environment, it is also subject to pressure from its peers. Is the company an industry leader, a rising star, a niche player, or a new entrant? And how does that impact the emerging threats and opportunities? Understand the company's competitive advantage. Is it a threat to substitutes or disruption? Consumer trends, demographics, regulation, the environment, and more. Long-term trends and positive structural factors may compound and play an important role in a company's success. Being wise to these factors can improve your valuation methodology. Understanding the individual business can add value, but understanding how it fits into the wider economy is equally important. Key focus will be on earnings and revenue growth, financial strength and profitability. While qualitative analysis will justify your investment preference, financial data will guide your valuation. Companies with large debt piles, poor cash flow and low growth should be discounted accordingly. Predictable cash flows and higher growth will command a higher premium. You can make well-informed forecasts using your knowledge of a company's history, financial performance, strategy, competition and market dynamics. This is the necessary first step in calculating your valuation. Your valuation model will typically discount future cash flows by your assessment of risk and opportunity cost. There may also be hidden value in ongoing corporate investment, research and development. You may foresee various scenarios which lead to differing end valuations. This variance may need to be discounted, and the manner in which they are combined into one single valuation may vary. Various metrics may also be used to corroborate the valuation to comparable companies. But remember, for your valuation to be correct, the market will have to agree with you. We typically associate stocks with specific company and market risks, but other risks may include geographic, economic, inflation, and interest rate risk. Understanding the interaction with these risks will help discount valuations and build a well-diversified portfolio. Some businesses may have outcomes with fatter tails, and therefore be more suitable for differing investment time horizons or valuation methods. The proliferation of qualitative and trend-following investment vehicles, along with passive but selective vehicles, means that sentiment and trends can carry more weight and leave markets open to greater shifts in volatility. Companies that have gained momentum may have done so because investment vehicles have channeled funds in their direction. An example of this that may play out in the years ahead is ESG investments. That sums up the key steps, but there is an infinite amount of information that can be used to make investment decisions. To cut through the noise, capital can manage your investments for you.